Good morning, everyone. And on behalf of the Association of Corporate Treasurers of South Africa, I'd like to welcome you all to this morning's webinar on managing liquidity in uncertain times. For those of you who don't know me, I'm Artemis Galatis, and I'm the General Manager of the Association. And it's been uncertain times for us too, of how to keep our members informed of what is happening in the international world, in the local environment. So it's been quite uncertain and difficult for us. But I must say thank you to Investec for sponsoring the webinar today. We have a wonderful lineup, and to introduce you to the speakers, Annabel Bishop, she is the Chief Economist of Investec, Richard Wainwright, who's the CEO of Investec, and Jörg Basler, who is the Group Treasurer of SAPI. And SAPI have been members of ours for many years and great contributors. And now we also have a member, Serena McGinn, who is on our board. So thank you to everyone. Thank you once again to Investec. And at this point, I'll hand over to Annabel. But just before that, should anyone wish to ask questions during the presentations, please click to the left of the audio player and tap on the question mark. So over to you, Annabel, and thank you very much, everyone.
Hi, Richard and Jörg.
Good morning, Annabel.
Good morning, Annabel. It's good to be here on a cold, frosty morning.
Well, thanks very much for joining us today. Jörg, can you run us through some of your experiences that SAPI is having as a result of COVID-19 across the geographies you operate in? And of course, give us a brief overview of SAPI, and particularly how the current environment compares with various different market conditions you have seen before.
Thank you, Annabel. I can certainly do that. Maybe by way of background, until 1990, SAPI was a purely South African forest products company. And in the 90s, after the relaxation of exchange controls and sanctions, SAPI was able to expand internationally. And we used the 90s really to make some key strategic acquisitions in Europe and North America to become the world's biggest producer of what's called coated wood-free paper, essentially the highest quality paper that you can get used by advertisers and fashion magazines, coffee table books, so really the top quality. And so with that development of becoming a global leader and with operations in different parts of the world, we also established an international treasury here in Belgium. And so we have the experience of raising funding and managing cash and commodity and foreign exchange and interest rate exposures from our group treasury here for the non-South African business, but also in South Africa for the South African business. So we have both local experience and international experience. How has COVID-19 impacted us? Well, the positive news is that all of our mills globally are operational. So right throughout the crisis, right throughout the lockdown periods, we've been able to continue operating. The consequence really is both direct and indirect. Direct, as demand for certain paper has, of course, reduced quite materially. Coated paper itself, the demand decline is between 25 and 30%, so quite a severe drop-off in demand. But on the other hand, packaging paper and what we call specialty packaging has been quite strong. So those mills that produce specialty packaging, in fact, have been running full right throughout the crisis, as the need for certain packaging for, in the health sector is very strong during this time. That's the direct impact. Indirect is, of course, we are also the largest supplier of what's called dissolving wood pulp. It's the chemical, the cellulosic content of a tree that goes primarily into textiles. And so as our customers who use the DWP to make what's called viscose staple fiber that goes into textiles have been impacted by the lockdown, as many clothing stores have closed around the world. Of course, the demand for textiles has reduced, and that then is an impact right through the supply chain. And as less VSF is produced, it also means less DWP is produced. So, of course, we have then the indirect impact of DWP reducing as well. So overall, a mixed bag of direct impacts and indirect impacts, some positive and some negative.
Yes, but certainly it's a very, very severe situation. Richard, I was wondering if you could run us through what you saw in the early stages of the crisis.
So Annabel, I think firstly at the outset, I think we should I'd like to say, as South Africans, living and managing our businesses in an emerging market, we're probably more experienced than many at managing volatility, whether it be across financial markets or, as Jorg was saying, currencies, commodities, and liquidity itself. Certainly when I look at some of my colleagues in the more developed world, they're not used to or immune to the kind of volatility that we generally are. But I would say that nothing can quite prepare you for this kind of crisis, where for many companies, and you've just heard from Jorg, SAPI affected less so, but many of our clients where their revenue went to almost zero overnight, or if not zero, a substantial drop off in revenue. And how do you actually prepare yourself for that? There's not many scenario analyses that you could have run that would have predicted that kind of outcome. So you were really, although we were immune to volatility and maybe more prepared as South African banks and corporates to withstand this kind of move, it was still devastating anyway. And, the early signs that we saw was the first stresses we saw were actually in the financial markets, particularly the bond market, which crept into the corporate bond market, which, some of the institutions that were long of corporate debt, which was relatively illiquid and were using leverage in the form of futures or repos to take on that credit, were the first panic stricken. And that immediately fed through into the banking system, and then the corporates responded immediately. And what I would say is that the role that our central bank in South Africa played, using the various macroprudential instruments that it had available to it, in my opinion, was textbook. They absolutely played it almost perfectly. They stabilized the bond market by opening the repo windows quite early on, which brought liquidity and stability back to the bond market almost immediately. And that gave a sense of calm. There were other macroprudential instruments that they used to assist banks, and then banks were able to assist their clients. So, obviously we were following what was happening around the world with corporates who were immediately drawing down on their general banking or their committed banking lines as liquidity buffers. We saw a little bit of that, particularly from the larger companies, the larger, more sophisticated corporates would phone their banks, talk to their banks, asking, are the facilities still available, and companies just drawing down on it. So those were the very early stages. The other effect that we had in South Africa was the impact, particularly on the dollar market. So for those companies that were borrowing in dollars or using the dollar rand swap market to create dollars or to hedge, you saw massive dislocation in that market. And that was a global phenomenon, as there was a flight to safety, and immediately you found a dollar shortage around the world, not only in emerging markets. And that took a few weeks to stabilize. And I still think we're seeing the remnants of that. You'll see the pricing of dollars moving around, certainly in emerging markets anyway. So, we were really in the eye of the storm. I think as South Africans, we were probably well placed to deal with it. And as I say, I think our banking regulator, played it by the textbook, and all compliments to them.
Yes, they certainly did, and that was actually my second question to you. So I think returning to on the central banks and the regulatory environment, but I agree they did extremely well. So Jorg, over to you now. What is your current experience in the various geographies you're finding at the moment? Taking into consideration your traditional products and mix of funding, and particularly what is the balance you normally try to achieve between the quantum and liquidity headroom and the price you pay for this? Maybe you can expand on your traditional funding products and the mix you use, and of course the tenor, and has this changed as a result of COVID-19?
Oh, Annabelle, look, let me summarize it as follows. SAPI, like many pulp and paper companies, is in a cyclical and very capital intensive business. When you want to build a new paper machine or a new pulp machine, you're talking in excess of $1 billion. Acquisitions are always in hundreds of millions of dollars. Our maintenance capex per annum is between $150 and $170 million. So when you have that kind of intensive, longer-term sort of asset base, the way we split our funding really is to look to the bond market for long-term funding. You know, a paper machine has an economic life in excess of 60 years. So you want to try and match some of your debt with those long-term assets that you have. So we've raised 10-year bonds, we've raised 30-year bonds, we've raised 7-year bonds. So all the long-term funding requirements that we have, we typically place in the long-term market, both internationally and in South Africa, incidentally. We then use the banking market for backstop liquidity funding. We have revolving credit facilities, one international, one in South Africa, that really serves as a backstop liquidity facility for our working capital requirements. On top of that, the working capital is also funded by securitization programs. So we use our receivables in securitization programs. We use some supply chain funding, and also locally in South Africa, we use the commercial paper market. So it's a mixed funding bag. It's an approach that really matches our needs across the globe for our various funding requirements. So your question was, has that been impacted in the last few months? It certainly has, more locally than internationally. Internationally, you know, our rating internationally is a BB flat rating. And that means as a high yield company, you do not really want to allow your maturities to creep up on you. Typically, when we look at our maturity profile, we refinance bonds 2 to 3 years ahead of time. Last year in 2019, we refinanced the 2022 bond, 3 years to go, and we refinanced it with a new 7-year bond, knowing that access to market is very important. And in the high yield market, we've had experiences in the last 20 years, whether it's 9/11, whether it's the global financial crisis, markets can just close down. Not for AA names or single A names, but certainly in the high yield space, markets closed down. In 2008, 2009, we actually had some maturities to refinance at a time when the market was simply closed. So the big lesson for us in the global financial crisis was make sure you refinance your maturities well ahead of time. Very conservative, but necessary. So it's a very conservative approach. In South Africa, we haven't had to do that, simply because we have a local AA rating. And as a well-known company in South Africa with very low debt, strong cash generation, we've always been able to access the local bond and CP market. And in my 21 years at SAPI, we've never had an occasion where we have not been able to tap the market at short notice, except for the first time this year. So, you know, every crisis teaches you something. And the big lesson for us, I would say, in the South African funding funding aspect from this crisis, is that we will also use a more conservative approach. Once a market closes and you experience that, you will change the way that you behave. So I would say going forward that we will also be more conservative, now knowing that the South African market can also close, even for well-known AA rated companies like SAPI.
If I can just add to what Jorg was saying, and he probably takes it for granted, but I know Jorg and his team have a strong relationship and keep a strong relationship with all their providers of capital through the various cycles. And that is very, very important for companies to understand, is to maintain that relationship, not only with banks, with capital market investors, even sometimes equity market investors. You've seen internationally, many companies go to the equity capital markets to get emergency funding. So I think the most important thing is to have the strong relationship, open and transparent relationships with all your providers of capital, because this is the time when you need it. And I know the SAPI group, for example, come and see all their providers of capital in South Africa on a very regular basis. So when you go to a credit committee, when you get a call from a company that you have that relationship with, it's very easy to respond, whether you're a capital market provider, a bond in the bond market, or a bank. It's very different if you don't have those kind of relationships, where you want to try and get emergency funding and you don't necessarily have those deep relationships with your providers of capital. That can be problematic. Or where you're not ready in terms of your financial information that you have available. What has surprised me in this crisis is the number of companies that have come to us, even not, and SAPI is not one of these, but even some big name companies who came to their providers of capital, like Investec, like a bank, saying, you know, I need some funding. Can I draw down on some lines? And the minute we started asking some questions around, I'm talking about management information questions around liquidity, stresses, scenarios that they may have run, they couldn't give the necessary response. So the two things for me, and something that SAPI's done particularly well, is one is keep those relationships, and two, be able to respond to the information that those capital providers need in order for them to make those decisions quite quickly.
Annabelle, if I may, I can actually provide a very good example of exactly what Richard has just said. Is it okay if I respond to that?
Oh, wonderful. Please do.
Okay. Because my previous comment, I spoke about the fact that bond markets can close. And we've really seen that in the South African market over the last couple of months, where it's really a case of bond investors and asset managers just preferring to stay in cash. They're preferring not to allocate liquidity during this time. And that's their position. Now, we happen to have a small bond maturity in April. It was a 745 million bond maturity, which, based on previous experience, we always thought we could refinance fairly quickly in the local bond market. But of course, when that didn't happen, we immediately went to our relationship banks, and you know, that's exactly what we did. We refinanced that maturity with a 12-month bridge, knowing that over the next 12 months, the bond markets will normalize again, and we will then be able to refinance that bridge in the bond market. So it shows exactly what Trish is saying in practice, in principle, in practice, by leveraging and by using those relationships to get through this crisis.
Richard, when we talk about scenario planning, what is the bank's thinking and planning for such an uncertain environment? And how do corporates plan for such an uncertain environment?
Well, Annabelle, you know, as banks, we are obviously highly regulated. And post the financial crisis, both in terms of capital planning and liquidity planning, there's a whole stream of new regulations that came in that require us to have liquidity buffers, capital buffers, and to be able to withstand down case scenarios as you've described. So, you know, Stephen Kosov said to me the other day, he said, Rich, do you think the banks would have survived had we not had the global financial crisis and all the regulatory amendments that came in, the deleveraging of banks that took place? I mean, it's a realistic scenario that many banks wouldn't have survived this particular pandemic, given how revenue just and economic contraction just occurred so rapidly. So we were the beneficiaries of having gone through that in 2008, 2009. But you know, to your point about scenario planning, we're doing it all the time. And in fact, we're asking our clients now for that. Because of the level of uncertainty that we're all facing across many, many sectors, we're asking clients, what is your assumptions around when does revenue normalize? Or when does revenue go back to 50%? Is it in the third quarter, fourth quarter, first quarter next year? Show us your various scenarios. Just as banks, particularly for those companies that are relatively highly geared, and companies that have been severely affected in sectors like tourism, hospitality, etc., aviation, the airline industry, is that we do expect our corporates today, particularly the larger ones, to have a sophisticated scenario planning system in place that can provide us with the necessary information that we're looking for. And it does make us uncomfortable when a company comes back to you and says, well, it's going to take me 6 weeks to run these scenarios. Well, 6 weeks is a long time in this type of crisis. And it doesn't give you the kind of comfort that you want. So those companies that are able, even if it's very high level, some high level scenario plannings with some basic assumptions and run their cash flows and the impact on revenue and debt service, etc., we do expect that. And the companies that are more sophisticated and can provide us that information, banks will support. So that's been our experience. I've been quite surprised with the lack of sophistication around some of the scenario planning.
And Jorg, if you'd like to come in here with any comments on scenario planning, and of course, also, what are you currently finding as your biggest challenge? What really keeps you up at night? Does the current environment impact the CEO, CFO, treasurer relationships? And are you finding there's more pressure on the treasurer? We're really interested to see how you're dealing with this.
Well, a treasury team is always very popular in a crisis, and we've gone through a few crises, and all of a sudden treasury is the top team in the company, right? Everyone wants to know about cash flow forecasting, debt management, liquidity. It's on top of mind for everybody, and when everything is in place and the crisis is behind, then we go back into the back room, into the back office, and just make sure that everything functions very smoothly and nobody has to worry about treasury. So at the moment, we're very popular, and also overworked. But I think we have a very effective cash management structure across the group. You can imagine we sell to over 100 countries in the world. A lot of currencies flow into the SAPI cash pools. So we have a very sophisticated system. By 8 o'clock in the morning, we know exactly what our cash balances are around the world. And so very important is to manage the cash very carefully. We typically have a weekly rolling 4-week cash flow forecast, and normally reviewed and prepared on a weekly basis. Right now, I can tell you it's a daily exercise. So cash is king. Cash is very important in managing across the group, and so that is key focus around the group is to manage the company around its cash flows. The most important thing I think for us also, as we go through another one of these crises, is just to be conservative. To be financially conservative is underrated. Refinancing your maturities early, making sure you have cash buffers, making sure that you don't let your working capital blow out, having your capex taps under control, looking at your dividends, for example, and having the flexibility if you have not to pay dividends like we have. So all of this is a conservative approach to managing your finances, and sometimes that costs. I think you mentioned that in one of the questions is, do you pay for this? And yes, we do pay. We do pay for having largish revolving credit facilities in place that provide liquidity when we need it. But I think paying those fees is part of just being financially conservative, and all of that really stands you in good stead when you go through a crisis like this, where a lot of unexpected things can happen. And you say, what would keep me up at night? It's uncertainty. It's really the uncertainty of how will this pandemic return, at the end of the pandemic, return life to normal. When we went through 9/11, it was a severe impact on global economies, but we saw the way out. In the global financial crisis, it was a banking crisis, and with all the actions by the central banks across the world and the regulators across the world, we could see the way through the crisis, and we could see how it would unfold. Right now, in this pandemic, we don't know how it's going to unfold. To what extent will demand return? Will it return as quickly as we thought it will? Will it not? Some things may never be back to normal again. Who knows whether air travel will go back to pre-2019 levels, and if so, by when? Will the sale of textiles in our industry specifically, return to normal, and how quickly? Will advertising return? So it's all this uncertainty that this pandemic has caused, I think, is the real challenge for all the companies.
Yes, I certainly agree with you. And the longer the lockdown persists, the slower and the lengthier the recovery will be. And certainly, while there has been some easing in restrictions, the return to the level of economic activity experienced at the end of 2019, certainly for South Africa, we don't think it's going to get there before 2025. We saw in the last quarter of 2019 a real GDP outcome of 3.2 trillion. And that's, of course, adjusted for inflation. And, we really only think that we're going to see this again in about 5 years' time or so. And this is something, which has been quite widely seen around the world as well. We also risk seeing business failures escalate and, of course, fewer jobs to return to once the lockdowns are over. And Richard, I want to turn to the 200 billion credit guarantee scheme now. And of course, the risks that these jobs and companies will not be saved. And of course, the impact that the credit guarantee scheme is obviously looking to have. The economy is clearly very vulnerable. and it is going to be attempting to restart in the third quarter. And of course, under the various easing of the restrictions, there have been some corporates in different areas that have been seen restarting now. But of course, the credit guarantee scheme is a government intervention. Perhaps the question I have to you is, why did it take so long, and how does it work? How do they choose who to help?
So, Annabelle, it took so long because we don't have the fiscal space that other developed economies had. So you saw in other parts of the world, the governments move immediately to put cash into the system in different ways, into households and into corporates, particularly smaller companies. We didn't have that fiscal space. So it really took a partnership between the private sector and the government to work out a scheme. The Banking Association was part of that. So it took us a number of weeks to get that off the ground. Once we'd got some momentum going with the politicians and with the regulators, it moved relatively quickly. So it got implemented on the 11th of May. It would have been nice if it had been 4 or 5 weeks earlier than that. And the take-up was quite slow to start with, but it has started to ramp up now. And the way it works, at the moment, it's designed for companies with turnover of less than 300 million. So it's really at the smaller end. And it's designed to cover 3 months of operating costs to keep people employed and to keep the cash circulating in the economy. There's a lot of work now that's been going on over the last month as we've seen that implementation phase, where we're going to make some changes to it. So right now, we're actually in working groups right now with the Prudential Authority and National Treasury on recommendations to accelerate that and maybe make it a little bit broader, maybe some larger companies, maybe some specific sector interventions. But this really is a working relationship between government, the public sector, and the private sector, the banks. It's using the bank's infrastructure to get the cash into the system as fast as possible. We've had some minor issues on execution because a company has to be registered with SARS, for example. It's got to be in good standing pre-COVID, et cetera, et cetera. So it doesn't apply to everyone. But it was done. It was a unique South African solution for our set of circumstances.
Richard, could you expand on what the large corporates are experiencing in South Africa, and of course some of the perhaps criticisms you have of the plan?
One of the criteria we set out right at the beginning was it was not going to be available for listed companies, whether they were listed, their equity was listed or their bonds were listed. The thinking behind that was that they had access to the capital markets, the equity markets. Now, what we saw in South Africa, unlike in other parts of the world, very little take-up of the equity markets. In Australia, the UK, Europe, US, you saw lots of companies go to the equity markets fairly quickly. South Africa was quite slow. We have seen in the last few weeks about 5 or 6 companies go to the equity markets now, which were actually very, very well received. We were fortunate that of the 5, I think we were involved with 3 of them, 4 of them. So it was a little bit of a slow take-up, and that may be a function of the fact that South African companies, generally speaking, are under-leveraged relative to their international peers, and had sufficient space that they didn't need to go to the equity markets. So that was the reasoning behind it. There is talk that we extend that scheme and make it available to bigger companies. There's also a requirement for the very, very small micro companies, which are not normally banked by the banking sector per se. The SMMEs, there's many of them that are banked by what they call non-bank financial intermediaries. Some people refer to it as the shadow banking system. That sector employs a lot of people, quite unregulated, and they also need access to cash. And that is something that's very much on the National Treasury's agenda, is what kind of scheme or facilitation does government put in place for the SMME space? So that's still work in progress.
Richard, I think that really talks to the fact that you're seeing 95% of businesses really unhappy with conditions in the second quarter of this year. You know, the Business Confidence Index recently released shows that this is a historic low, the worst that's ever been recorded since 1975. And of course, you know, this compares unfavorably with 82% dissatisfied in the first quarter. You know, what we're really finding is a very difficult economic environment. And I think we've outlined many of the risks and experiences we felt, but of course as well the interventions from government itself. Clearly we'll obviously be looking to see if they do bring in more if we go through a more difficult environment, but I don't think that's our central case scenario. Our central case scenario is that we start to see consolidation now and we eventually start to see an improvement in the economy, and certainly we have seen already some consolidation in financial markets and of course some lift and improvement there. But obviously it's a very difficult environment. So thank you very much for your participation, Richard Wainwright and Jorg Passler. And we are now open for questions. Please submit your questions and we can start taking them. We have a number of questions so far. See, we actually have two split, two for Richard and two for Jorg. Perhaps, Richard, if I can start off with you. The first question is, what was the reason and thinking behind government's decision to restrict support to companies in terms of the 300 million and below? And I assume this actually pertains to the 200 billion loan guarantee scheme. The second question for you, Richard, is what plans did the banks have to make with regards to its own liquidity management in the current environment and at what additional cost?
Okay, thanks, Annabelle. So just some background to that scheme. The thinking from government was really to aim that scheme at smaller companies who were deemed to be most at risk. And in fact, where the vast majority of people are employed is in the medium to smaller companies. And this really just followed on the trends that you saw around the world. So the turnover cap of 300 million was set by National Treasury together with the Reserve Bank. So the thinking was to get the emergency funding into the areas of the economy that needed it the most. I mean, there's been some subsequent discussions which around either lifting that cap or removing it completely and opening up unutilized portions of that scheme for the rest of the economy. And we may see some announcements today from the minister. I'm not privy to what he's going to say, but in the coming days, if not today, you'll probably see some lifting of that. Do you want me to answer the second question now, just in terms of the bank's funding?
That'd be great. Thank you.
So I think as I said earlier, I think in the early stages of the lockdown, we saw some dislocations in the capital markets, the debt capital markets, most of which has lifted now, and I'm sure Jorg can explain what his experience has been in there. And banks are utilize that funding channel as well. I think from Investec's perspective, what we did when we saw what was going on around the world, we actually started increasing our liquidity buffers well in advance of the lockdown. So we were using all the various channels that a bank would use, whether it's retail deposits or corporate deposits or capital market funding lines. We went very long of liquidity. To what Jorg was saying about being conservative, we went very conservative. Now, what is the cost on that is, our shareholders will have to bear the cost of the surplus liquidities that we run. But we think that that's worth it. So we prepare to pay the extra cost to be conservative. Over and above the statutory minimum liquidity requirements that the central bank puts on all banks. So,
thanks, Richard. And Jorg, certainly a number of questions for you. In fact, they keep coming through now. I'll start off with a couple and then we can keep going. So first of all, what processes and tools are used in the cash flow forecast, and what was the challenges in adapting them to the current scenario?
Annabelle, there was one question before that, which I think
yes, there
maybe
was
I
as well.
should
Let me run
address
through that as well. Yes,
yeah.
okay. What other funding products do you use in your mix of funding? And of course, there's been a lot of noise around the alternative funding solutions, and this is supply chain finance. The understanding, and the question carries on, is that this is very active in the international markets and slowly gaining interest in South Africa. Do you have any thoughts on it? And of course, are you aware of users in the international market seeing disruptions given the current environment?
Yes. So, I think the importance in any capital structure is diversification of funding. You never want to be really reliant on a single or two sources of funding. And also for what is the specific purpose of each source. So typically we would look at using the bond market for all of our long-term debt. We look at using the revolving credit facilities as strategic backstop facilities, supporting liquidity. And then for working capital, there are a few other products that we certainly use and that I would also recommend. One of them that we use is securitization. So using your debtors book as a securitization program raises funding at very attractive costs because the securitization vehicles are typically have top short-term ratings. So you're able, even in our international contacts as a double B company, we raise debt at a top investment grade rate. So securitization is always good. Supply chain funding, we use to some extent more to encourage our suppliers to take some more discounts because what we essentially have is an electronic platform. Once an invoice is approved, we upload it, and then the supplier can decide themselves whether they want to get paid early for an additional discount. So that kind of supply chain funding arrangement we have as well. It's fully automated, as I say, on a web-based system. So again, it diversifies your funding sources as well as some trade finance. Depending which countries you're based in, we have a strong presence in Austria, for example, and the government has a very strong trade finance facility available. So you can use that as well as an export in those countries. So key message is diversification of funding is very good. Have we seen dislocations in those? No, we haven't. Right throughout the crisis, all those programs have continued to run as expected. And essentially what underpins all of them is liquidity. And there's been plenty of liquidity in this market during this time, and strong support. Do you want me to move to the second question on the cash flow forecasting?
I think so, because you've got two more to follow that as well. But to recap on that question, what processes and tools are used in the cash flow forecast, and what was the challenge in adapting them to the current scenario?
I'm pleased to say that cash flow forecasting for us has always been a very strict discipline. It goes hand in hand with the way that we've managed our cash management system. We are very centralized from a cash management perspective. Before 8 o'clock in the morning, we know exactly what our cash position is globally. And that, of course, is very helpful in planning your cash requirements for the days and the weeks. We have an SAP system globally, and we have a continuous rolling 4-week cash flow forecast, bottom up, so very rigorous. And then we break that 4-week rolling forecast into weekly and daily forecasts. And that has really been our discipline. So has this changed during the crisis? Absolutely, more in terms of accuracy. The accuracy of the forecasting is most important. So as I say, a rigorous process, and that has continued, and in fact, even more rigorous right now.
That's great. Thanks very much. And yet another question for you. What activity are we seeing in the IRS and FRA market? Is SAPI fixed or floating, and through what tenure?
We tend to take decisions on fixed or floating based on the interest conditions at a point in time. And unfortunately or fortunately, it also is linked always to hedge accounting. We've always believed that we do not want derivatives and hedging decisions to cause volatility in the income statement. So, and what that really means is that on the day that you take up new debt, you have to decide at that point in time to make sure you have hedge effectiveness throughout the life of that instrument. And so if we were to take up a new bond today, and it's often, South Africa, for example, has a preference for floating rate bonds. Internationally, it's fixed rate. We then decide at that point in time, what is our mix? Do we want to be more exposed to fixed or floating? And then we decide whether to swap those new debt instruments. So in principle, it's a decision we take at the point of taking up new debt.
Okay, and one of our listeners has said, you mentioned that being conservative and having secure liquidity comes at a cost. Does SAPI have a framework, policy, or decision protocol for determining what level of liquidity is appropriate to balance having sufficient liquidity while still keeping costs down?
Yeah, it's an excellent question. And I would say, every crisis makes you consider the way that you've managed the business and managed the finances, and then decide whether that is still appropriate. Now, the cost that I was referring to was the fact that if you have a backstop facility, an RCF, for example, of course, it costs you quite a lot in commitment fee. But that cost is quite small in the context of having access to that liquidity when it's really needed, in the context of supporting your ratings, for example, and supporting generally your financial health. So it's a cost well worthwhile. And would we change it in the future? I'm quite certain that we will do that. The level of the RCF typically assumes that you have access to the other markets. A good example, for example, would be in South Africa, where we have historically used the RCF also as a backstop facility on the assumption that under our DMTN rated AA with a very well-known name means we have access to the commercial paper market. As most of you know, the CP market has been quite difficult in recent weeks. So if you now have learned that the CP market isn't always available to you when you need it, you will probably decide, hey, maybe we should have a slightly larger RCF just to cater for those kind of circumstances. And I think these are the thought processes that many corporates are going through right now. Is the level of liquidity that we have arranged under normal conditions sufficient for stress situation? And I think everybody will come to the conclusion that being more conservative, increasing your liquidity is probably a good way to go, even at the increased cost.
Thank you. And Richard, there's a question for you. Is there a cost associated with the credit guarantee scheme?
A cost from whose perspective? I mean, from the company that's borrowing under the guarantee scheme, the pricing's at prime. So I suppose to the extent that you're utilizing it as a company, you have to compare that to other sources of debt. Is it expensive or not? I mean, at prime, designed 5-year product priced at prime, designed initially for smaller companies, we felt was relatively cheap. From the participating banks' perspectives, this is a break-even product. So there's no net cost unless we get default rates that eat through our 6% first loss. But if it's successful, it's at a break-even point of view from banks. The cost of capital is covered, and there's no further profits to be made. So there's administrative costs, I suppose, from a bank, but you've got those in the ordinary course anyway. So my view would be that there's very little cost for the banks, and it's reasonably well priced for the customer.
We've only got one question left, and it's to myself. So, Richard, I was wondering if there's anything you want to say on any of the other points raised or commented on so far.
Yeah, maybe just to comment on some of the issues that Jorg spoke about, the insurance and the cost of being conservative. I must tell you, as the supplier and the underwriter of the insurance, whether it's through commitments, committed lines, or RCF lines, from a bank's point of view, we think it's very cheap. At places, I think from a corporate point of view, you take a lot of liquidity risk and you place it back on the banks, because we have to build up the necessary buffers across our entire base, our corporate base and others, where we have offered commitments and we have offered RCF facilities. So we think it's very cheap, actually. So if you view it as an insurance product, that it's something you're only going to use when you really need to, we think it's probably very, very cheap. And as banks, but that is the role that banks have to play. And it's a competitive environment, and the market will determine the pricing based on supply and demand. And then we have to hedge ourselves on the back of that. We have to make sure that we as the banks have sufficient buffers and liquidities and the like, so that when our clients do come, that we have the liquidity ourselves to support them. So I think it's a fairly well-priced product, and I think more corporates should follow what Jorg's example and Sappi's example and utilize them.
Our last question's on the IMF, and specifically says, will the IMF fund the loan requested by our government? And the listener adds, he heard that there were conditions that the government is not happy with. And I think, the key point here is that when the IMF makes a loan, and, our government has already announced there could be there certainly could be up to 4.2 billion available, and that's in US dollars. It does come with conditions. And of course, the relative situation is these conditions are likely to be certainly quite light in a COVID-19 loan. But if South Africa wants to apply to the IMF for deeper loans and obviously to help in its funding, then there are certainly going to be substantial conditions. But that's all that we have time for today. So thanks very much, Richard and York, and I'll hand back over to Artemis.
Thank you very much. I think there were many salient issues that emanated from the discussion this morning, which I'm sure many of the participants found particularly useful. And once again, a huge thank you to Richard, Jörg, and yourself, Annabelle, for addressing the ACTSA delegates, and to the Investec team who made it all possible, and of course to Peter Ratty. So on behalf of the association, we look forward to once again engaging with all the ACTSA members and people in our database. And all I can say is take care until we chat again. So thank you.